questions and turn it over to you if you're comfortable.
Yeah.
All right. So a very good morning to you all. Very good evening, Mark and some of the others. Good to have you here. Welcome to this month's Enterprise and Technology Working Group meeting. This meeting, along with all of our other working group meetings, is subject to both our antitrust and confidentiality policies. So please keep that in mind during your commentary and questions. Speaker protocol within this meeting. Please identify yourselves and your firm or what you're working on if you can, particularly if you've dialed in by phone. And finally, Zoom protocols. We've never had it happen, but in the case we get Zoom bombed, we will end the call immediately with apologies to all. But other than that, I will turn it over to the chair of the Enterprise and Tech Working Group, Ms. Sonia Goklani.
Hello, everybody. Thanks for joining in. Today, we have a Bancor, which is one of the forerunner in the AMM space, and they're actually creating liquidity in the marketplace with their platform and their protocols and with their coins. It will be interesting forum because, I mean, this is the whole new space that's been evolving, and I kind of draw parallels to the F10 network and to the equity markets trading, the algorithmic trading that you have. And kind of look at everybody to, so it's going to be a little more of education on what AMM is and how it's going to, play out in the future in terms of the models that they've built and in terms of the impairment loss that they're going to, how they're calculating it. And they've done some extensive risk research and, the calculations and forward thinkers. So it'll be a very interesting, perspective. I don't think we may be able to cover everything in this session going forward. We might do, a fireside chat with Mark and Nate, because there's so much that needs to be actually looked into. After talking to Mark, I had so many questions in my head and so many scenarios to think about in terms of if this token converts into this, then what happens? And if, how does it play out on different exchanges, a regulated exchange versus unregulated exchange? So, it's a whole new world. So I'm sure a lot of people will have questions, but I think most of the people are just basically going to digest what AMM is going to do. So Mark, you kind of have to bear with, people are going to look at it as a more education session. Whoever I spoke to about Bancor, they were like, hey, we need to understand AMM better before we actually ask more questions. So please, you're going to get a lot in the next session. So we're looking at you to actually drive this, Mark, for us and kind of, walk us through how AMM is going to, like a forward thinker, how do you see it, helping the crypto market, how to get institutional adoption into this space. So that's, I want to set the stage for you and for Nate to move forward. Okay, thanks, Mike.
Sure.
So is yours.
Thank you very much, Sonia. Guys, confirm that, could you turn my screen sharing on so that we can present the PowerPoint?
Yeah, sorry, you should be able to do that.
No problem.
Now.
But while that's occurring, I'll just introduce myself. My name is Mark Richardson. I actually don't come from a traditional finance or economics background. I actually was a physical scientist for the first 13 years of my career. I used to, I had my bachelor in science from Macquarie, my PhD from the University of Melbourne. I did my first postdoctoral appointment at UCI under Greg Weiss, building nanotechnology sensors for various medical applications. After lecturing for the Department of Chemistry for 2 years, I returned back to Australia and began a second postdoctoral appointment at the CSIRO. And during the 2020 pandemic, my research trajectory was thoroughly interrupted. I had a research grant to go to Berlin and complete a rather significant leg of work under the supervision of Peter Seeberger at Max Planck in Potsdam. And so it was really during 2020 that I sort of refocused my efforts into DeFi. And it was about a year after that I picked up a full-time position as the head of research for Bancor. So it's been quite a journey, but that's my position now. I'm a full-time researcher there. And so what I'm going to be doing today with this presentation is kind of in a way, no assumed knowledge introduction into automatic market makers. And so, yeah, please, I'm really looking forward to having a much more detailed conversation with what sort of the implications of some of the information is that I'm presenting today. But yeah, this is just going to be sort of AMM's 101, what is Bancor and what makes us special, what are we trying to achieve? Okay, so to begin, we need to sort of introduce some helpful vernacular. You're going to hear in DeFi, we talk a lot about liquidity pools, and I don't think that it is safe to assume that everyone knows what a liquidity pool is. And so just very quickly, a liquidity pool is just a smart contract that contains crowdsourced capital. And so usually you can think of this as essentially just a pile of cryptocurrency representing some store of value. And the implication is that that capital is going to be used for some sort of yield earning activity somewhere else in DeFi. And so this could be something like borrowing and lending, or making markets through exchange, or some sort of risk transfer activity. An automatic market maker is kind of the next level up, right? The next layer built on top of these smart contracts that are containing crowdsourced capital. And what automatic market makers do is they allow liquidity pools to exchange cryptocurrencies between each other. And that allows for, essentially exchange rates and things to be borne out on blockchains the same way that they are, the same way that they operate in traditional finance. So this allows for things like, if there's a cryptocurrency representation of the Australian dollar and a cryptocurrency representation of the American dollar, then you can effectively have a decentralized Forex that doesn't have things like Nostro Vostro accounts. And so this allows for an immediate exchange between two different assets. And those markets are made essentially without any sort of government or institutional oversight. And this is kind of what makes market makers so important, is that they are starting to become a part of an emerging decentralized global financial network. Just recently, the amount of value processed by automatic market makers on Ethereum just recently passed $500 billion. And so it used to be sort of a boutique, sort of academically curious, right, way of thinking about how to make markets and whether or not these are a viable model. But I would say over the course of 2020 and 2021, they've really sort of come into their own and have established that this is likely to be a viable means of building out the financial infrastructure of the future.
So Mark, one question for you here. So when the regulators, when they get their act together, how do you think this platform would be impacted? Like, I mean, there will be different regulations in Europe versus the US versus Asia, Switzerland. And we all know Switzerland has a different, way of working. I mean, I personally come from, I work with UBS and Credit Suisse. So I kind of see them, having a different play. And then how does Bancor predict that? How do you build that into your platform?
Yeah. So in terms of US regulation, we've recently appointed a legal team to help us navigate the SEC and the financial regulation in the United States. But the Bancor Foundation, which is a Swiss nonprofit, has been set up and continues to operate under FINMA regulations and supervision. And so everything that Bancor does really on the European markets is already closely regulated. And so for the moment, they don't really take much issue with it. Things like AML and KYC and anti-terrorism financing and things like that, so far haven't been too much of an issue, as long as it is just the retail space interacting with each other. I think by the time that the major institutions of the world want to start deploying capital on these platforms, that there is going to have to be some level of KYC introduced. And we are often talking about things like ring-fenced or walled garden approaches to deploying these systems, so that KYC entities can operate these automatic market makers between each other without necessarily having to get their money dirty with un-KYC capital. So there are easy ways on blockchain that we can adapt the regulatory framework that already exists in the traditional financial space. And in fact, it's actually even easier to enforce that regulation on blockchains than it is in the rest of the world. And one of the reasons for that is these public blockchains are always, they're auditable at any point, at any time of day. And the entire transaction history is always completely out there in the open. You can see every address that's interacted with every other address. So I think actually from a regulatory standpoint, I think it's likely that many governments are actually going to start embracing this way of doing things, simply because bad actors and you'll never be in the space where a regulator is going to have to ask to see your books. They can just look at it by reading the blockchain at any time. So I'm not sure if that's completely answered your question, but certainly at the moment, the only regulatory bottlenecks that we face, I think, is the anonymity of Ethereum right now is less than ideal. But as we've seen with some of our competitors and other financial service providers on Ethereum, they've started to offer what we call sort of the institutional grade products. And these do have things built on top of them, such as KYC and AML compliance protocols.
Okay, thank you. Let's move forward.
Okay, so the question then is, how do these automatic market makers work? I imagine that there's a lot of people in the audience who have come from a traditional finance background and are probably familiar with the order book system of market making. But automatic market makers do not have order books, and they do not have a counterparty. And so what's so interesting about them is that the person that is trading against them has a guaranteed price that they know beforehand. And so they're not exposed to a spread of any kind. And instead, they're exposed to something called slippage, and we're going to explain a little bit about what that means, and also how the liquidity providers are economically incentivized to provide liquidity to these systems. So the first major concept that you need to wrap your head around is what we call constant function pricing, and there are many different derivatives of this, many different flavors, but the simplest and still the most common, and the first to arrive on the scene, is called the constant product. And it's exactly what it sounds like. The product of the assets inside the liquidity pool must be kept constant at all points during the trade. If you've been hanging around Ethereum chat rooms, or if you've been exploring DeFi a little bit, you've probably heard the term bonding curve before. This is just the graphical representation of whatever that function is that the liquidity pool is using to make markets. So in this case, a constant product is a cone section or a hyperbola that asymptotically approaches both the X and Y axis. And this is helpful, and we're going to see this in a couple of slides, because it means that there is an infinite range of potential prices between two different assets that this market maker is able to cover. And so what I'm going to show you right now is just using a constant product. We're going to set up a liquidity pool, and then we're going to use an AMM protocol over the top of it. And then with a hypothetical trader, we're going to swap one asset for the other. So in this example, we're going to use BNT, which is the native token of the Bancor network, which is this black icon here, and Chainlink, which is another very popular cryptocurrency. And so these letters X and Y are just the algebraic representations for some quantity of these tokens. And I think that that's important for you to keep in mind as we continue. Okay, so imagine that the seller, they've got Bancor network tokens, and they are wanting to exchange those Bancor network tokens for Chainlink tokens. Okay, and this could be because they are, executing a trading strategy, or it could be for utilitarian purposes, right? Maybe they already own BNT tokens and they need Chainlink tokens in order to pay Chainlink for some service that they are trying to get access to. It doesn't really matter. The purpose is that the point is that they have BNT, they don't have Chainlink. So we're going to assume then that they're selling 10 BNT tokens, and the number of Chainlink tokens that they're going to receive for that sale is the thing that we're trying to work out. When they approach the liquidity pool, we're going to let the balance of tokens inside there be 100 in each. So it's going to have 100 BNT tokens and 100 Chainlink tokens. If you multiply those two numbers together, you end up with 10,000, and that's the number we're going to try to keep quote unquote constant. And this is where I need to introduce the first caveat, and that is that this constant value actually isn't constant. In order to allow the liquidity pool to absorb additional value from the market, from the traders, a commission has to be paid, and that commission is realized as a slow drift in that constant. So as the constant grows, the total value of the assets inside the liquidity pool should grow with it. And that is how a liquidity provider actually makes earns fees for the service that they're providing. Okay, so we've got the liquidity pool and we've got these two tokens. And then on top of that, we've got this layer of logic that we call the protocol, okay, which is just a set of instructions that is going to take all of these numbers as inputs, perform some calculation, and then output some other numbers that are going to tell the liquidity pool what to do with the assets that it was provided. So the first calculation is simply adding the amount of BNT tokens, which was X, to the reserve inside the liquidity pool. So if it started with 100 and the trader is trying to sell 10 of them, then we already know that that the final balance of BNT tokens inside the pool is going to be 110, which is relatively simple. The one that is slightly more complicated is the number of Chainlink tokens that is going to remain inside the liquidity pool after this trade is performed. And so for this, the naive approach would just be to take the number 10,000 and divide that by 110 to generate some number. But remember I said that this delta value, the 1%, is the commission that the liquidity provider is asking the trader to pay in order to make their liquidity provision worth their while. And so we add this delta value to X and we generate a new number, which is now 91. The K value is usually something that we don't even need to compute, but for the sake of clarity, I've included the calculation here just so that you can see that it did grow from 10,000 to 10,010. And that change in its magnitude by 10 units is the amount of liquidity that has increased inside the pool that the liquidity provider now has ownership of. So the actual, in a sense, they've earned passive income. They've earned interest for their market making activities, and that is defined by this equation. So this is how the liquidity pool changes, right?
Mark, 1 minute. I think Ron has a question.
Hey, Mark,
Sure.
I'm sorry. Just to dive into this a little bit, and this is fantastic. Just when we're talking about the bonding curve, just real quickly, the K0 changes when we're talking about the size of the liquidity, that particular liquidity pool, correct?
Correct. Yeah. So the K0 is so remember, I'm using the subscripts 0 and 1 to represent points in time. So X, Y, and K are the values associated with the pool at the beginning, and then X1, Y1, K1 are those values at the end of the trade. And so yeah, K at 0 was 10,000, and K at 1 is 10,010, and that growth is essentially the amount of fees that the liquidity provider has earned.
Yep. And in my mind, I always say K at time zero when from transaction to transaction. But one question I want to ask you, when we look at AMMs, the other really interesting hallmark of that is that you and I can open up we can contribute liquidity in real time to the platform. So I guess my question becomes, does K at time zero change in real time as new liquidity comes in whilst transactions are happening? I know I'm kind of peeling back layers a little bit, but K at time zero can be pretty complicated.
So K at time zero, we just mean that before the computation of the trade. But you're right, when you're adding liquidity to a pool, K is also going to grow at the same time. And that's because when you're adding liquidity, you're adding both X and Y tokens, right? So if X is BNT and Y is Chainlink, then as you're adding both of those things, then of course the product of all of the assets in the pool at that time is going to grow. But that growth isn't associated with any actual fee accrual by the liquidity providers. That's just saying if I have $100 in the liquidity pool and you come along and add another $100, K is going to double.
Yep.
Or actually square, sorry, it's going to end up 4 times larger. But you and I haven't actually made any money, right? I still only have $100 and you still only have $100. So that adding, removing liquidity component is separate from this delta that is causing the amount to change as a computation is occurring related to a trade. So and that's kind of what I want to drive home here, is that it's as a trade is being performed, there is like a calculation as to what the fair value is for the tokens that a trader is selling. And it always skims off just a tiny amount, right? It's usually somewhere in the ballpark of 0.2 to 1%. And that amount that gets skimmed off is just subtracted from the tokens that the trader would receive and left behind in the pool. And in order to crunch that, all you need to do is allow K to increase a little bit.
Got it. Mark, appreciate it.
Yeah, my pleasure. Okay, so that is how the liquidity pool itself is changing. And if you wanted to, you could actually just stop here and see that, okay, the X value has increased from 100 to 110, but the Y value has decreased from 100 to 91. And so that change in Y, that must be the tokens that the trader has received. And indeed, that is true. But you don't have to rely on that deduction, that you can have a separate line of calculations to provide that output separately. And so this might be the sort of thing that you do in a smart contract in order to make sure that you have 2 different sources of truth. Because if someone is attacking your protocol, for example, you don't necessarily want to rely on a single function generating an output that tells you how many tokens to literally leave the liquidity pool and put into somebody else's hands. It's better to have 2 different independent equations that are both arriving at the same answer, and then maybe compare those. And this can help to deal with things like rounding errors and other things as well. So in this case, Y is just the amount of tokens that the trader is receiving. And you calculate it this way, and you can see that we're getting to the answer 9, which, thankfully is the difference between Y0 and Y1 here. So we do have good agreement that this is the number of Chainlink tokens that the user will receive.
And Mark, just to bring home an obvious point here, I just want to make sure, is that thinking very juvenilely, 1% on 100 is 1. And so essentially the fee or broker fee, slippage fee, whatever you want to call it there, rather you in a non-fee world, you would have exchanged 10 for 10. Now you're exchanging 10 for 9 because you started with 100. Very simplistic.
Yeah. Okay. Correct. Yeah, that's exactly, that is exactly what it means. Yeah. So yeah, this is the summary of the whole process. At the end, the number of BNT tokens inside the pool has increased by 10. The amount of Chainlink tokens has decreased by 9. And the user has essentially sold 10 BNT tokens for 9 Chainlink tokens. And so this is how automatic market makers perform their work.
Mark, what if you
So-
don't have Chainlink tokens? Then what happens?
So it's actually impossible for the protocol to ever run out of Chainlink tokens. Let's back up and see why. So if we have a look at that constant product equation, X times Y equals K,
Mm-hmm.
what value of Y, so we've got Y being Chainlink. What value of X would you need such that Y is equal to 0 and K is constant?
Okay.
If we put it another way, if Y is 0, K over X is an undefined number. Meaning, if you were to extract all of the Chainlink tokens from the pool, you would need to supply an infinite number of BNT tokens. So this is actually a really interesting, feature, I would say, of AMMs, is that you don't ever need liquidity of last resort. They never stop trading. It really just comes down to how much slippage, right, the trader is willing to tolerate. So yeah, if you have an infinite number of BNT tokens, you could potentially exchange that infinite number of them for all of the Chainlink in the pool. And that would be the only way to keep K constant. But there aren't an infinite number of BNT tokens in existence. So if you took the entire market cap of BNT, you could actually calculate how many Chainlink tokens you can extract before you run out of money. But there will always be some Chainlink left in the pool. It will never run out.
Mark, that's the asymptotic function, right? When you look at that curve, because you approach infinity.
Correct.
In the asymptototic function.
Yeah, and I'm actually about to
in geometry, Mark.
I'm actually about to demonstrate that. If we think about how this curve works, right? There is a spot price, which is a theoretical value, a theoretical equivalence that the bonding curve is telling you the exchange rate between BNT and Chainlink is. But then there's also an effective price, which is that the fact that you have performed a trade has actually changed the price that you are being quoted, right? And so the fewer tokens that you're trading, the less far you stray from that idealized spot price. And the more tokens you're trading, the greater the slippage. And so this is a pretty simple calculus problem, but we can think of basically the delta X part of this, right? Which is the amount of BNT that the trader contributed to the curve as being the amount of some token that was sold, and the negative delta Y being the amount of token that was purchased, in this case, the amount of Chainlink that was purchased. And so if we want to generalize this, all we need to do is make Y the subject and then take the inverse reciprocal first derivative of that curve. And you'll see that we end up with the indefinite term that the price is X squared over K. And so from here, we can actually just extract that out and make sure that we've got a line that is just tangent to any point on the curve. And then you can just observe that as we move this line around, there's actually no point on the curve because it's asymptotic where we cannot generate a price. And so this is really helpful because there are some cryptocurrencies that have astronomically high values, right? For example, things like YFI or Bitcoin, which have valuations now in the $40,000 to $70,000 range. And then there are cryptocurrencies that have very, very low valuations, like AMP or Shiba Inu, which have fractions of a cent. But you can put these two currencies together inside a liquidity pool and generate a bonding curve for them. The only question is, where is that tangent that sets the relative ratio of these two assets against each other in such a way that the market is generating a price for them that they're expecting, or that's commensurate with secondary markets. And so, yeah, there's literally no limit to this. It's impossible to drive the price of either to zero, as Ron pointed out, because it is an asymptotic function. And so now we get to sort of the gritty part of automatic market making, and this is something that I think is generally not well understood anywhere. So if you think you have an existing confusion about impermanent loss, or you've heard about impermanent loss being discussed but didn't really understand it, don't feel bad. I speak with other DeFi professionals, and even they have a pretty poor understanding of it. And I think that over the next couple of slides, I've got a way to present it that is going to make it feel a little bit more visceral, and really crystallize what this effect actually is. So coming back to thinking about the fact that we need to extract some amount of tokens from the curve and supply some other tokens to the curve in order to move the price of one asset versus the other. So you can think of what it would look like for the Chainlink price to move versus the BNT price. If we are using the liquidity pool and the automatic market maker as a price reporter, right? If this is the thing that we're using to determine the price of Chainlink versus BNT, then a trader can move the price of Chainlink simply by adding a lot of BNT to the curve and extracting a lot of Chainlink from the curve. And as long as that positive delta X is moving quite high, and the negative delta Y is moving quite high as well, then you can move the price of Chainlink versus BNT. What this means is that the asset that is becoming more valuable, right, as the value of Chainlink is increasing, its relative quantity inside the curve is decreasing. Okay, and so as a market maker or as a liquidity provider to a market maker, the valuable asset, right, the thing that you really want to have more of is always going to a smaller number, and the asset that is not as valuable is always the thing that you're accumulating more of. You can think of this as sort of a delta hedge option strategy, or some sort of short straddle or something like that. It's very, very similar, and in fact, our chief economist has written up an economics paper that compares the AMM model to an options pricing strategy. And so if that's helpful, I can introduce you to that literature.
If you could,
you can also
love to share that.
Yes, absolutely. I'll send that to you on after this presentation. But you can also flip this on its head, which is that as the quantity of Y is decreasing, its value is increasing. So you need to sell the valuable token before its price increases, right? It's the actual act of you losing it that caused its price to increase from the perspective of the automatic market maker, from the perspective of the liquidity pool. And so what we end up with is kind of a quantitative analyst's version of seller's remorse, right? It's a catch-22. If you didn't sell that token, its price wouldn't have moved. But the act of selling it causes its price to move. So before it can become worth more, you have to get rid of it. And that is that can be a problem, because in DeFi, in cryptocurrency, the people that are providing liquidity with their assets, they actually like their assets, right? They want to keep their position. They want to maintain exposure to the asset that they're providing liquidity with. And often they don't understand that when they finally get that day that their asset outperforms the rest of the market, like if you're providing liquidity with Shiba Inu, for example, the day that it finally goes 1000x versus Ethereum, you don't realize that that's also the day that you lose 99% of your Shiba Inu. Okay, and that is a big problem. And so we can actually very, very easily determine what that loss of value is, right? Because you might think, sure, okay, you might be losing the more valuable asset, but you're accumulating a very large amount of the other one. As long as the other token isn't worthless, your overall portfolio value is increasing, and that's true, but it's increasing as the square root of what we call the HODL value. So this is how this works. At any time when you're evaluating an AMM position, you only need to look at one of the buckets, right? So if you added up all of the BNT in the pool, it would have exactly the same value as all of the Chainlink in the pool, right? It's always an exact 50-50 split. So if you know the price of BNT and you know how many BNT tokens are in there, you know that if you just multiply that number by 2, that you've got the total value of the liquidity pool without ever having to count the Chainlink, and vice versa. So that is the AMM portfolio value. The HODL portfolio value is slightly different. For this one, what you're going to be doing is you're going to be looking at, okay, at the end of some period where the AMM has exchanged assets, accumulated some of the thing that isn't worth as, let's say the least valuable of the 2 assets, it's accumulated a lot of that and it's sold off a lot of the more valuable asset. You've now got new values for X and Y. And if you process those numbers this way, and then compare these to each other -1, you can actually get a dimensionless number, right? So a unitless number that represents the actual loss in value experienced by the liquidity provider versus them not doing anything at all. And so this is the important point, that when we are talking about how profitable participating in automatic market makers are, we're comparing it against the HODL position, right? Which is a bastardization of hold. I'm sure you guys understand what this means. But yeah, we're talking about, is a liquidity provider incentivized to do this from the perspective of just leaving their assets in their, in their cold storage or on the exchange where it's safe. And so if that's the if that's the reference point that we compare everything to, then it's very, very easy to demonstrate that this AMM method, it has some shortcomings. And so this is the final equation for calculating impermanent loss. And I am, if anyone needs any of these equations after the presentation or the presentation itself, please let me know. Okay, so impermanent loss is not just this number because it can be offset by fees that are paid by users. So this equation is for the 0 fees example, and that helps to make it general, but it also means that it kind of obfuscates the fact that the fee accrual on the pool can easily overcome the impermanent loss cost. This is what it looks like graphically. So we're imagining a case where the price of Chainlink started at a 1-to-1 rate with BNT, and then slowly over time approached a value of 10x versus BNT. Now for this simulation, I think I was running an arbitrage trade against the pool at every, I think in every 100 basis point tick range, and with a 0.2% fee against the pool, I think. But you can see what's happening here is what I was describing before. The amount of BNT and Link in the pool starts at 100 each. And then as the price of Link is increasing, you can see that it is very sharply decreasing, and the BNT is accumulating over time.
And Mark, if assuming no activity going on, you started with a liquidity pool, someone had 100 of BNT, someone had 100 of Chainlink in your example, and there was no activity going on, but outside endeavors were causing the price of the two assets in this case to move. What does the AMM do in that circumstance? Since no one's asking to borrow or sell, but theoretically the prices are moving.
Yeah, absolutely nothing. And so if no one's interacting with your AMM, then you've effectively just got a HODL position. And so what's interesting is that if that is true, if no one's trading against you, then you're not exposed to impermanent loss. But you're also not earning fees. And so you don't have that, you don't get that that opportunity to make money over your HODL position, right? Which is what the objective of these kinds of markets is.
So someone who's holding a position in your AMM is not suffering any movements in price until there is an action taken.
Yeah, in fact, the market maker, the automatic market maker, it doesn't even know about outside markets.
Yeah.
and so what we're really asking here is, okay, why is someone trading against the pool? And so we know that, you know, arbitrage trading is going to be an extremely important aspect of this. And in a way, AMMs are dependent on efficient arbitrage to make sure that the exchange is offering a price profile for all of the assets on that exchange that's comparable to what you would see on Coinbase or Binance or something like that. And of course, the incentives to arbitrage an AMM are huge. Because if no one has traded against that pool after the price has moved on the order book on Binance, then you can literally, buy Chainlink off an AMM and then sell it in the same instant on Binance and turn a very fast profit. And so there are very, very sophisticated arbitrage bots that process hundreds of billions of dollars a day in arbitrage, just keeping the DEX liquidity reporting a similar price to the centralized exchange liquidity. And I would say in the beginning of DeFi, it was that way around, right? Like something would happen on Binance or on Coinbase, and an arbitrageur would then approach the decentralized exchanges and, you know, buy an asset from those pools and then sell it on Binance or something to readjust the prices. But now it's a lot more sort of competitive. It can be now that something like Bancor or SushiSwap or Uniswap can actually be leading the charge on the new price discovery, and it's Binance and Coinbase that are being arbitraged against these pools. So it's no longer the case that the centralized exchanges are the ones that you should trust for a good price. Sometimes it's actually the decentralized exchanges that are giving a much more accurate reflection of the market sentiment with regards to one of those assets.
Hey, Mark,
sorry. Yes, sure, Ron. I was just going to say, Ron, go ahead.
Yeah, sorry, Mark. So I have this conversation a lot with my colleagues that are what I'll call traditional Wall Street. And what my understanding, I just want to make sure I'm clarifying this in my head. There are no AMMs that mark to market given any price activity outside of the pool.
Yeah, so this model has been experimented with, and so we use things like Chainlink price oracles that can help to readjust the liquidity reserves. But what we found is that if you do that, the centralized exchanges will abuse it. And so someone who is in charge, and so this is one of the reasons why, you know, decentralized exchanges exist, is that we don't trust the people keeping the order books. And so what they would do is deliberately move the price in order to exploit one of the decentralized exchanges and drain its liquidity, and then move the price back after that trade had been performed. And so what we found was it's actually just better to let the liquidity pools be self-managing under the simplicity is usually the thing that you're striving for. And so this little constant product function is really sufficient to keep the pools behaving well. And we never key off anything that's happening anywhere else, which is good because it also means that we're not dependent on centralized exchanges to run our exchange. You can make markets with assets that centralized exchanges aren't allowed to make markets with. So for example, you know, things like, there's a protocol called Synthetics that has synthetic assets built around stocks and commodities and other things. And they use an AMM model in order to make markets between things. And they also don't need price feed data, although they do use it to a small extent. But we're not talking about synthetics, we're talking about Bancor. And we don't use Chainlink price. We don't use price feeds of any kind. Mark,
thank you. And Sonia, if I could, just one follow on, and that makes perfect sense. I really appreciate that, Mark. You know, we're talking about Chainlink and BNT, given the universal ecosystem of Bancor tokens, how do they onboard to Bancor? I know I'm probably skipping ahead, but how do we define that universal tokens that are available on the Bancor network?
Yeah, so there's two different types of pools. One is what we call the V1 pool, and that's exactly the system that I've presented here. And then we've got the version 2.1 pools, which are very special because they are insured against impermanent loss. So anyone that is providing liquidity there can be guaranteed to at least get their HODL value And if the pool is performant, then they get fees on top of that as well. So that means that liquidity providers have the peace of mind that they will never lose money on one of these insured pools. That insurance mechanism is something that is voted on by the Bancor DAO. And the Bancor DAO is essentially the community of BNT token holders who have contributed liquidity across the network. And that liquidity is essentially their stake in the protocol and affords them voting rights. So it's not enough just to own BNT tokens, right? If you go to Binance today, you can buy BNT, but you can't vote with it. BNT is not a governance token. It's a utility token that powers exchanges, the universal numeraire of the Bancor exchange. But if you provide it, the fact that you have that value in the protocol means that you should have a voting right for how the protocol is maintained. And so one of the things that we have to vote on is which assets we should afford this insurance benefit to, and how large those pools should be, what the swap fee on those pools should be, that kind of thing. So that's how it's onboarded. It's a DAO process. I think we actually have a very well-defined set of procedures that takes a token from being something that's not present on the Bancor network at all, up to that insured status, and there are other nuances as well that I think we'll have to save for another conversation, because we're getting way down into the weeds of that protocol.
If I can just jump in here, and I'm still lingering in the background, I think one of the core, and this sort of answers your question, is one of the core innovations of these liquidity pools and creating an exchange with them is that really anyone can list a token so long as they have the other asset that they put in within a pool. So in the V1 pools, it's what we call permissionless. So anyone can permissionlessly list an asset and have it be liquid to any asset in the Bancor network. Then once it gets to this phase of a more mature token, it can be whitelisted by the Bancor DAO, which is made up of holders of BNT, and they can allow other assets to receive this thing called impermanent loss insurance, and also make their pool, a little more special. But they typically have to be a more established asset. But if you want to, anyone on this call can go to Bancor right now, go through our interface, deposit some of their tokens or a token they want liquidity in with BNT, and have that exchangeable with all assets on the platform,
Nate,
including
thanks.
ETH or WBTC and a lot, all the mainstream assets too. So that's really how Bancor launched, is a liquidity solution for the long tail of assets. We've now seen AMMs also onboard all the blue chip and larger assets too, from ETH to WBTC to all the tokens you guys might know of.
Nate, thanks. Sonia just wanted to know who to call when she wants to launch the Sonia token on the Bancor network. I wanted to make sure.
You don't have to call it. You don't have to call anyone. You can set it up all by yourself. But if you want to get it whitelisted, talk to me, and I can introduce it to the DAO, and we put together a proposal together.
Mark, Nate, thanks very much.
There's already a Sonia token out there.
I'm sure there is. Okay, so in this chart, we were looking at the actual reserve balances of BNT and Chainlink changing. This chart is the actual value change of your position. And so what I want you to see here is that with the orange line in HODL, as Chainlink is appreciating in price, the value of your position of your portfolio is increasing linearly, but the AMM is increasing as the square root, which of course is a derivative of the fact that it is a constant product function. And this is what brings us to the losses. This curve you can derive as being the delta between the orange and the blue line on here. And so I'm just representing it here as a percentage. And so what's heartbreaking for a lot of people is that in this case, if Chainlink went 10x versus BNT, then you'd be suffering about a minus 40% versus the the reference of doing nothing at all, which is terrible for more than one reason. One is that we want to incentivize people to actually do this. This is extremely supportive for the DeFi ecosystem, and market making and exchanges is an important part of keeping everything healthy and functioning well. And deep liquidity is going to be an extremely important part of the utility that people get out of cryptocurrency. So this, I don't think is acceptable. And it's often not communicated very well to liquidity providers that this is a risk that they are taking on. And so what's special about Bancor is that, as I was saying before, we have a whitelisting process where certain pools are granted insurance against this particular effect. And so how we achieve that is that there is a very small insurance premium charged on the fees that each pool earns. And that is used to kind of offset to mutualize and offset the risk. But also the fact that there are so many different pools within the network that have this insurance mechanism connected to it means that the risk is also sufficiently diversified that it becomes a relatively predictable element of the Bancor ecosystem. And so what we're hoping is that this is going to become a stabilizing force within DeFi, where retail users can use Bancor as something like a high interest savings account, right? Something that they can deposit their cryptocurrencies, including US dollars, right? Like things like USDC and USDT. They can deposit these things just into the Bancor network and have the network generate passive revenue for them, while also supporting market making activities on Ethereum, for example, and helping to support DeFi overall. So it's actually very similar to how a bank might offer its customers an interest rate if it's doing market making activities in traditional finance. But the overheads are much, much smaller because one, the trader themselves is interacting directly with the user funds. There's nothing in between, and there's no, there's none of that red tape in the middle that would usually siphon away some of the earnings that the customers would otherwise be enjoying. Okay, so this was the launch of V2.1, right? This was the insurance paradigm that we introduced, and what we were trying to address with this version was really, that exposure to impermanent loss really had to be something that we did away with. And so the choice of Chainlink and BNT is actually not incidental. It's actually one of the most prominent of the BNT community members, right? It's gotten to the point now where you can't really tell the Chainlink and Bancor communities apart. And I think that I can articulate precisely why the Bancor product has resonated so well with Chainlink holders. And one is that they sincerely believe that their token is the best token, right? That it has the best fundamental value, and that over time that value will be realized. And so they absolutely will not risk exposing themselves to impermanent loss, because they have this, this almost super spiritual certainty, right? This absolute faith in how valuable Chainlink is, that they refuse to expose themselves to that, because they won't consider for a second that they're wrong about it, right? They don't want to they just would never second guess that Chainlink is going to become the most valuable cryptocurrency that there is. And maybe they're right. The other thing is that they often want to hold as much Chainlink as possible because of that conviction that Chainlink is such a valuable asset. They find it repulsive that they would be asked to sell off some of their portfolio in Chainlink in order to rebalance it versus another asset. So Bancor version 2.1, everything that I presented today says that you have to provide both sides of the pool. But actually Bancor introduced something called single token staking, which means that you don't actually need to provide the BNT and the Chainlink. You can just provide the Chainlink, which means that you have the ability to assemble your portfolio in precisely the way that you want, without being forced to, to balance it with the correct numeraire. And so this is the kind of flexibility that we think is going to make Bancor not just attractive to the retail space and the enthusiasts and zealots that are already dominant on crypto Twitter, for example, but also the institutions that want to make sure that they can have exactly the weights of different assets in their portfolio that they want, without having to worry about how the numeraire is processed. So this is the status quo. You need both of these tokens. It's usually Ethereum on the other side, but of course on Bancor network, it's BNT. And with Bancor, you can just do it with the one. Okay, so the Chainlink token always has this habit, right, of kind of outperforming everything else. If the last few years have been really good to Bitcoin and Ethereum, but Chainlink has appreciated on both of those assets about 8,000% over the same time period. And so if you were a Chainlink holder over that time, you were even providing liquidity against something like Ethereum or Bitcoin, you would have lost the majority of your Chainlink and lost out on those potential gains. And so this is the status quo, and this is the option. This is the product that you're being offered when you go to some of the rival dexes, right? So something like Uniswap V2 or SushiSwap, and I actually have an example right here. So this is a graph that I've constructed that looks at the price history of Chainlink versus Ethereum over the entire history of SushiSwap's launch, right? So just I didn't choose an arbitrary time period. I just said, okay, SushiSwap launched on this day. If you were providing Chainlink versus Ethereum on SushiSwap on day one and let it carry out until whenever I made this graph, which was August of this year, you would have made negative 15%, right? And that's compared to doing nothing. And I don't think that this is acceptable. On Bancor, it would have been this orange line, right? And so this difference here is quite profound, right? This is a 20% difference. And that is the product that we are now taking to market. So we actually invented, I didn't say this earlier in the presentation, but Bancor invented the AMM. We were the first to introduce this model and start working with it. And it's been iterated many times. We live in an open source, an open source world, and so we can't blame other projects for taking those ideas and running with them with their own branding and things. But none of them, I think, really feel the same responsibility that we do to sort of fix some of the issues that we introduced with the product when it was first released. And so we really feel like with version 2.1 and the insurance model that we've introduced, that we've kind of really hit it on the head, right? We've now been more than a year of liquidity providers providing liquidity on our platform, almost $2 billion in TVL, and none of it has experienced impermanent loss that whole time. We are now heading into our version 3. And so we've been, this is going to be a very, very significant part of our narrative for the next 12 months. I'll be announcing the features of version 3 at Decentral in Miami on the 30th of November. So if anyone is around town, please come and find me. I'll be happy to meet you there. But essentially, version 2.1 was a prototype, right? This insurance model, this idea that a DEX, a decentralized exchange, can also be an insurance protocol, was brand new in October of last year. We were the first to do it, and it has worked amazingly well. But it was still really unknown space that we were heading into. And so the last year has been sort of an experimental period where we gathered data and refined the economic models. And that is now going to go into our Bancor version 3. And we're going to start offering even more sophisticated features on top of what we already have, which I think is already a fairly impressive go-to-market strategy. And so, yeah, I hope that that was a helpful presentation. I'm sorry if I kind of jumped around a little bit. It's 4 a.m. currently. And, but yeah, if you've got any questions or if you'd like access to these slides or any other information, if you'd like to set up a private call, I'm happy to entertain all of these things. This is my contact information, and I'm also happy to answer any questions right now.
Thank you. This was actually very interesting. I opened up the floor. I know we've gone over, but we still have like 5-6 minutes if people want to stay and ask questions, because I just wanted to make this a little more educational. So please go ahead, Donna, Dwayne. Not to put you guys in a spot, but we have. If nobody wants to ask questions, then we can wrap it up.
I kind of feel like, Mark, you're gonna have to come back for deep dive number 2, because there's so much.
I would be so happy to come back for deep dive number 2.
There's a lot happening here, but unless there are any questions, Sonia, we'll have the recording available. Mark, we'll obviously let you and Nate see that before we give it to members and give that for you to share as well. But Sonia, any last questions that you had?
No, this is just so you understand, Mark, we're digesting all this information, and I'm sure people are going to come back. I'm seriously, it's a lot to take in one shot. But we do appreciate your time, and especially the time difference you guys have made it. Thank you, Nate, and thanks, Mark. Thanks for joining in. But
yeah,
we are going to have one more session going forward.
Looking forward to continuing the conversation, Mark. Everyone, thank you so much for joining. Mark, get some sleep. We'll chat. Thank you, everyone.
Bye, guys. Thank you.
Bye.